Welcome back to the deep dive. Today, we are opening up a file on a really specialized financial tool, one that often comes with a lot of emotional weight, the home equity conversion mortgage, or HECM.
Which is, the most common type of reverse mortgage out there.
Right. And you framed it perfectly before we started. It's like a power tool.
Exactly. It can be incredibly useful if you know what you're doing, but pretty dangerous if you don't. And this is a really important deep dive because, we're talking about trillions of dollars in home equity that's basically trapped for Americans over 62.
And that's the core of it, isn't it? The house-rich, cash-poor situation. For our deep dive, we're sticking strictly to the facts, using materials from the Massachusetts Division of Banks and Professional Planning Guides. No sales pitches here.
None at all. Our whole mission is to figure out, especially here in Massachusetts, with its specific rules, when a HECM makes genuine sense. And maybe more importantly, when it's just a huge, huge risk.
Okay, so let's unpack this from the very top. What makes a HECM different from, say, a regular mortgage or a home equity loan?
Well, the fundamental thing is that a HECM is a reverse mortgage that's federally insured by the FHA. It's designed for homeowners, generally 62 and up, who have a lot of equity built up. And the core difference is this. Instead of you paying the bank every month.
The bank pays you. Or, well, gives you access to your own
Well,
money.
exactly. You get access to your equity, and you stop making those monthly principal and interest payments.
And that idea, stopping a mortgage payment, that sounds like total financial freedom. That's the big draw.
It is. But that money, the interest on the loan, the principal you take out, it still adds up. It's debt. It has to be paid back eventually.
That's just deferred.
Precisely. The loan comes due when what's called a maturity event happens. So, when the last borrower sells the house or moves out or passes away. But, and this is a critical point, you don't just get to live there responsibility free.
Okay, what are those non-negotiables, the things you absolutely have to keep doing?
There are 3 core requirements, and this is where, frankly, most defaults happen. First, the home has to be your primary residence. Can't be a vacation home. Okay.
Second, you have to stay current on your property taxes and your homeowner's insurance. The HECM doesn't automatically pay those for you. And third, basic upkeep. You have to maintain the home. If it falls into serious disrepair, the lender can call the loan due.
Let's switch gears to the FHA insurance. This is where it gets really interesting, and it's what makes HECMs safer than some other private options. I'm talking about the non-recourse guarantee. Why is that so important?
The non-recourse feature is the absolute cornerstone of the program. It's the biggest advantage, really. It means that you or your heirs will never owe more than the home is worth when it's sold to pay off the loan.
Can you use a quick example? Because it can be a little tricky to wrap your head around.
Sure. Let's say a couple gets a HECM, and over 15 years, the loan balance grows to $350,000. But then the housing market takes a dive, and when the loan is due, the house is only worth $300,000.
So there's a $50,000 gap. Right. But because of the non-recourse guarantee, the heirs can just sell the house for that $300,000 and the debt is settled. That $50,000 shortfall, the FHA mortgage insurance covers it. Their other assets, their savings, whatever, it's all completely protected.
That's a huge safety net. It keeps the home from becoming a liability for the rest of the estate. Now, here in Massachusetts, we have some extra safeguards built right into the process.
And they're vital. Massachusetts really prioritizes consumer protection here. So before any loan can be issued, 2 things are mandatory. First, you have to go through counseling with an agency that's approved by the state's Executive Office of Elder Affairs.
And this isn't just a quick phone call.
Oh, no, it's an in-depth review. They go over the fees, your alternatives, what the loan balance could look like down the road. It's all about ensuring you're giving truly informed consent.
So it forces you to look at the hard numbers.
Absolutely. And the second thing is a financial assessment right up front. The lender has to verify that you can actually handle the taxes, insurance, and upkeep going forward. If it looks like it might be a struggle.
You can build in the solution?
Yes, they might require set aside. Basically, they'll hold back a portion of your loan proceeds in an escrow type account specifically to pay those future charges for you. It's a key step to prevent default later on.
Okay, so those 2 things, the counseling and the assessment, are strong checkpoints. Let's get into how you can actually use the money. It's not just one big check, right?
Not at all. The flexibility is fascinating, and honestly, the smartest strategies rarely involve taking a huge lump sum. You have 4 main ways to access the money.
Walk us through them, maybe starting with the fixed options.
Okay, so first you have the lump sum. That's usually with a fixed rate loan. You get all the cash at closing. People often use it to just pay off an existing mortgage. Done.
Simple enough.
Then you have term payments. This gives you monthly checks for a set number of years, say 10 or 15 years. It's good for bridging a specific gap, maybe until your pension kicks in.
And the third one, 10-year payments, that gets at longevity risk, which is a huge worry for people.
That's right. 10-year payments are guaranteed monthly checks for as long as you live in the home. Doesn't matter if it's 5 years or 35 years, that check keeps coming. It's the ultimate hedge against outliving your money.
And the fourth option? The line of credit. Financial planners seem to love this one.
Oh, the line of credit is by far the most strategic. It's flexible. You only draw what you need when you need it. But here's the really clever part. The unused portion of your credit line actually grows over time.
Wait, a credit line that grows. How does that work? Is that like a guaranteed return?
It's not a profit, but it is a guaranteed growth in your borrowing capacity. The growth rate is tied to the loan's interest rate. So the interest that would have been charged on the money if you'd taken it out is instead added to your available credit limit. It helps your borrowing power keep up with inflation.
That's a powerful planning tool.
Yeah.
So for that house-rich, cash-poor senior, what's the biggest, most immediate benefit they feel?
The biggest, without a doubt, is benefit number one: wiping out their existing mortgage payment. If you still owe $100,000, $200,000 on your house, using the HECM to pay that off can instantly free up, hundreds, sometimes thousands of dollars every single month.
And that cash flow is what lets them actually age in place. They can use their biggest asset to pay for prescriptions, utilities, just life.
And that connects to a more sophisticated idea, which is using the HECM line of credit to manage market risk.
You're talking about sequence of returns risk.
Yeah.
Write that down for us.
It sounds complicated, but it's simple. It's the risk of the market tanking right after you retire. Imagine the S&P 500 drops 20% in your first year of retirement. If you have to sell stocks to live on, you're locking in those huge losses, and that can wreck your portfolio for good.
So instead of selling low,
You use the HECM. That standby line of credit becomes your buffer. In that bad market year, instead of selling your stocks, you draw your living expenses from the HECM. You give your investments time to recover. Then, when the market is back up, you go back to drawing from your portfolio. It's about being strategic.
it's a way of optimizing your wealth. So it's clear how powerful this can be when used right. But now we have to get to the blunt side of this conversation.
We do.
If that non-recourse feature is so protective, how do people still end up losing their homes?
One word: default. It goes right back to those responsibilities we talked about.
Yeah.
If you're already behind on your property taxes or can't afford insurance, a HECM doesn't magically fix that. Falling behind on those payments is a default, and the bank can and will start foreclosure proceedings.
So it just trades one problem for another if you're not careful. You get rid of the mortgage payment, but you still have that $5,000 tax bill.
Precisely. It can make things worse if you don't plan for those ongoing costs. That's red flag number one.
Red flag number 2 has to be the cost, right? These aren't cheap loans.
Not at all. The upfront costs are substantial. You have origination fees, which can be up to $6,000, plus a big mortgage insurance premium, appraisal fees, closing costs. The initial insurance premium alone can be 2% of your home's value. That's a lot of money right off the top.
So if you think you might need to move to, say, an assisted living facility on the South Shore in a couple of years, this probably doesn't make sense.
Exactly. You wouldn't have the loan long enough for the benefits to outweigh those high upfront costs. This is designed as a long-term tool.
And then the big one for families, inheritance.
If your number one goal is to leave the house to your kids with as much equity as possible, a HECM is, it's designed to work against that. The loan balance is always growing because you aren't making payments. That growth eats away at the equity over time, sometimes down to zero.
But on the other hand, if you don't have heirs, or if your kids are financially stable, maybe that's a trade-off you're willing to make for a better quality of life now.
It is a deeply personal trade-off, and that's why it's a key part of that mandatory counseling session. It forces you to have that conversation about your goals.
Okay, let's get to the most important warning. This one coming straight from the Massachusetts Division of Banks. They see specific predatory tactics.
This is the one where everyone needs to have their guard up. The biggest red flag is anyone pressuring you to use the HECM money to immediately buy another financial product, like a high commission annuity or some risky investment.
So a salesperson says, hey, I can get you 100 grand from your house, and then we'll use 20 grand of it to buy this thing I'm selling.
That's the classic predatory move. Same thing with contractors who push you to get a HECM to pay for repairs they want to sell you. The state is crystal clear. That kind of linkage is a massive warning sign. You just walk away.
So what are the final non-negotiable due diligence steps for anyone in Massachusetts who's even thinking about this?
First, that independent counseling. Take it seriously. Bring a family member. Do it in person if you can. Second, shop around. Get quotes from multiple lenders and make sure they're on the state's approved list. The fees can vary a lot.
And get advice from someone who isn't getting paid to close the loan.
Yes. 1,000 times yes. Talk to a fee-only financial planner or an attorney who has no stake in the deal. Have them run the numbers. What does this look like if you live to be 95? What if home values drop? Understand the long-term impact.
So when we boil it all down, a HECM isn't a miracle, and it isn't a scam. It's a highly specialized tool. And here in Massachusetts, the protections are there, but you have to use them.
Exactly. If you use it strategically, it can be a source of incredible security. But if you're already in a shaky financial spot or you ignore the trade-offs, it can just dig a deeper hole.
And in the end, this whole discussion really comes down to a core retirement question, doesn't it? Are you okay with using your housing wealth for a better quality of life for yourself right now, knowing that it will mean leaving less behind as an inheritance? That's the real question you have to answer. If you have any questions about this podcast or are thinking about buying or selling your house anywhere on Boston's South Shore, give Jim Aldred a call. He would love to help you. Thanks for listening, and see you next time.